Thank you for joining us for this webinar today. I'm Adam Myers and I lead the distribution team at Pengana. For anyone joining today who is not familiar with our business, at Pengana, our key aim is to offer differentiated strategies which will add value to our clients' portfolios. We have no Me Too funds across our business. I'll shortly hand over to Nehemiah Richardson, who's going to provide an introduction to global private credit investing, and he'll discuss the reasons why we feel the current opportunity is so compelling. Nehemiah is the CEO of Private Credit. He's also a banking and financial services expert, having spent most of his career either advising large financial institutions or actually managing balance sheet or structured credit at banks or non-bank lenders. Nehemiah will be speaking for approximately 20 minutes, and after that, I will probably have one or two questions that I would like to ask, but there'll be plenty of time for questions from the audience as well. So please enter your questions into the Q&A box that can be accessed from the icon on your screen. Nehemiah, over to you.
Thank you, Adam, for that introduction. I guess firstly, I just want to welcome everyone and thank you very much for taking the time to join today. Really appreciate the time and interest, and I'm very excited to speak with you about global private credit. It's something that, as I've spent a lot of time looking at it, have become more and more excited about the proposition that it actually represents for investors to diversify their portfolios. So I guess the genesis of this was of this webinar is just our thinking that it was worthwhile providing some background on the asset class, particularly given the increasing press and market commentary around the strong growth and overall attractiveness of the asset class. Seems like every week there's a different article commenting on private credit generally and global more specifically, and that interest is really been particularly shown by the actions of institutional investors, because you'll see that the likes of the Future Fund and industry super funds have increasingly over the last few years started to allocate as part of their core portfolio structure, specific allocation of private credit, which can range between 5 to 10% of their portfolios. Now, specifically, the things that have attracted that investment is a potential for higher returns than what other fixed income alternatives can provide, and the floating rate yields that are actually paid by private credit investments. And then the overall yield premium that arises from the fact that private credit investments are held to maturity by the lender, and therefore the lender is compensated for the fact that it doesn't trade or the illiquidity of it. Secondly, private credit provides really nice diversification benefits to investment portfolios, given that it's got low correlation to more traditional asset classes like traded credit and equities, and low volatility since the underlying investments don't trade. And then I guess finally, private credit provides really nice capital stability and sort of resilience, given that the loans are individually negotiated and structured by the private credit manager. Generally, they have seniority and security over a borrower's cash flows and assets. And the lender will generally have the right to force a borrower to take corrective actions to protect the value of the lender's capital if that is necessary as a result of deterioration in performance from the underlying borrower. So I guess by the end of this webinar, I really would like to be able to leave you with three key takeaways. The first is that global private credit is a really nice, diverse, and defensive asset class that provides really attractive risk-reward benefits relative to other investment alternatives, given the favorable supply-demand dynamics that are present in global markets. And by global markets in particular, we're talking about North America and Europe. Secondly, global private credit is a very attractive way to diversify your investment portfolio, given that there's a wide range of risk return options that are available from the different types of credit investment strategies that are available for investment, and the low volatility and the low correlation I spoke about before. And thirdly, that it's really worth exploring how you can make global private credit a core holding in your investment portfolio. So now to get into it, I'll cover, what is global private credit, why the opportunity exists, and then why it's an attractive addition or part of a diversified portfolio. So what we mean by private credit. So when we're talking about private credit, we're referring to specialist fund managers who raise funds from institutional investors to lend directly to middle market companies that have profitable operations. And so when we talk middle market companies, we're talking about companies that have earnings before interest, tax, depreciation, and amortization, or EBITDA, of between $10 million to up to $250 million. Or we're talking about non-bank lenders that originate and manage profitable pools of assets. So, for instance, like mortgage originators or providers of consumer or commercial finance. And these lends are always made at quite sensible loan-to-value ratios. Given that the loans are bilateral, the private credit manager will typically get access to very detailed business and financial information from the borrower that allows the private credit manager to assess two things. The first being the company's ability to pay interest and repay loan principal from its operating cash flows. And secondly, to assess the value and the adequacy of the security that's available to the lender. So then, armed with this information, what a private credit provider will ultimately do after it's completed its analysis is it'll negotiate three things. The first is an appropriate interest rate to compensate for the risk. And secondly, what's sort of incorporated in the overall interest rate is also a view on the illiquidity premium that's required to compensate for the fact that the loans are held to maturity, meaning that they're not traded. And then finally, and very importantly, negotiating legally enforceable rights to be able to intervene in the operations of a borrower, to reduce the probability of loss should any of the pre-agreed operating and financial parameters that are set in the loan agreement were to deteriorate, and to ensure that the lender is able to exercise their security if that's required. And so within private, and these are kind of the general characteristics of what a private credit manager will do. And so within private credit, there are four broad categories of investment strategy. The first is direct lending, and direct lending just comprises bilateral loans that are made to performing companies at reasonable loan-to-value ratios, and generally with seniority and secured against assets and earnings of the company. The second bucket of strategies is structured credit, and these are loans that are dependent on the performance of a pool of assets that are originated by non-bank lenders. So, for example, like I said before, sort of non-bank mortgage lenders are a perfect example of that. The third category is specialty finance, and it's just like structured credit, but in the case of specialty finance, it's kind of a subset. So these will tend to be loans that are made to more specialized pools of assets, or to firms that have specialized expertise in managing assets, and the private credit managers in this category are really good at assessing the value of kind of niche types of assets and their cash flows and the risks associated with them. And so some examples of those might be aircraft leasing companies, mining equipment leasing, and royalty lending against assets like pharmaceutical patents or music libraries. And I think Taylor Swift actually might have done something kind of recent in terms of monetizing hers, and that probably would have been done by a specialty finance manager. And then finally, credit opportunities or distressed debt investing. And this is where the lender will benefit from dislocations in credit or equity markets. And simplistically, I actually like to call this category of of private credit, sort of the good company, bad balance sheet group. And really, in these circumstances, what these highly specialized private credit managers will do is they'll actually purchase the senior secured debt of a company, and that has a positive profit from operations. They'll actually have some issue, whether it be their balance sheet structure, where they might have too much debt on the balance sheet and they won't be able to service that debt, or a poor cash liquidity position, kind of meaning they may have a lack of available balance sheet cash to finance what might be a large and an upcoming debt maturity. And what these managers will do is they will leverage that senior secured position to be able to secure a balance sheet restructure in negotiation with a company. And in exchange for doing that and helping this company to kind of survive through whatever their issue is, they will typically get very high yields on the debt. They will get a share of the future equity upside of the company as it actually recovers from that situation, and will get very extensive and enforceable legal protections to take control of and operate the company if they need to in order to extract their return and protect their capital. And so, just to summarize, managers across all of these strategies will always seek to ensure that they have adequate protections in place to minimize the risk of non-payment of interest, and to ensure or minimize the risk of losing their capital, and making sure that cash flows and security can help them to recover. So that's a broad overview of private credit and and the types of strategies that are actually employed. Now I just want to touch on why private credit is an attractive opportunity and why it's actually come about. Now, firstly, the reason why we focus on North America and Europe as really the core parts of what global private credit is as an asset class, it's really about North American and European managers and assets. And it's because, they're very large markets in size. There's a really broad investor market awareness of the asset class. Borrowers actually see them as legitimate providers of capital, of loan capital, and they have creditor-friendly legal environments that mean, you can actually exercise and enforce your rights as a lender. And the structural dynamics that drive the ability to be able to realize attractive risk-adjusted returns. And when I say structural dynamics, that goes to kind of what has happened in the backdrop of these markets to enable the ability to extract really nice risk-adjusted returns over and above what you would see in more liquid traded credit classes. Now, so in these markets, meaning in North America and Europe, private credit actually plays a very significant and important role in providing middle market borrowers and non-bank lenders with access to credit. And this is because prior to the GFC, banks were the dominant providers of credit on a hold to maturity basis into these markets. Post the GFC, regulators imposed more stringent reg cap and or regulatory capital, I should say, and liquidity requirements on banks, which then had the effect of making loans to middle market companies and certain types of loans to non-bank lenders relatively unattractive relative to the other places that they could deploy their capital. And so, in effect, what happened was the banks withdrew from those markets or those market segments. And at the same time, many of you might recall there was quite significant bank consolidation that happened in U.S. and Europe. So there were larger but less U.S. European banks, and there were regulatory impulse that made it really relatively unattractive for banks to extend credit into certain types of market segments. And so the end effect of this was a creation of a very significant liquidity gap in the market, which is now actually being filled by private credit managers. And so as a result of that, and these private credit managers, remember, being funded by large institutions who are quite happy to take kind of longer term risk in exchange for the yields that could be generated by private credit managers lending to these groups of borrowers. So today, as you can see, I've gone on the slide, you have private credit managers in those markets, meaning US and Europe, fund 84% of middle market credit. And the other thing about the US and Europe is they make up 97%. If you look at the pie chart on the right, 97% of what is a greater than $1 trillion market. And, there's lots of projections that this growth is only going to continue to explode, given the significant liquidity gap that exists in those markets. And it's actually this liquidity gap that allows a private credit loan to generate an illiquidity premium. And I'll come to it later on to kind of show the really nice risk-reward trade-off that you get on the yield versus other traded credit alternatives. And finally, another sign of the maturity that you have in this market are the last 2 points, where you have wide investor acceptance, and so a lot of institutional money that's actually moving into the private credit space, and a very high borrower acceptance of private credit managers being really legitimate alternatives or providers of capital. And then finally, quite a diversity of different types of strategies that private credit managers will deploy into these markets, like I spoke about before. And in fact, within each one of those categories that I talked about before, there's actually been the emergence of even more kind of niche strategies that go to very specific types of issues that borrowers have, or solutions that they're actually trying to find, that are actually being built up at scale as private credit managers are able to take their knowledge and expertise to innovate into different types of niche strategies. And so when we then step back and look at, well, why would you do this when you can also access private credit in Australia? And in Australia, we have great private credit managers who do all 4 of the strategies that I talked about. And really the primary difference is in Australia, private credit as an asset class hasn't played the same role, nor does it have the same degree of acceptance as is seen in global markets. And that's primarily because the Australian banking system, demonstrated much greater resilience to market shocks, in the GFC and thereafter, given the much better management and the much stronger regulation and competence of that regulation provided by APRA. And so as a result, private credit in Australia is more concentrated in areas where the banks, who would predominantly have 90% of pretty much every major lending segment, would be sitting on bank balance sheets. And so private credit can play where there's where banks will have a more limited risk appetite. And so you'll generally find that it's kind of specifically concentrated more into commercial real estate, larger scale leverage loans. There's some mid-market, but not very much, and subordinated positions in asset-backed security vehicles, so residential mortgages, auto lending, consumer finance. So now just to quickly turn to the attractiveness of the asset class. And what we did to kind of try to demonstrate, or to try to quantify, well, why is global private credit and why is private credit generally a really attractive risk-reward position? So what this analysis attempted to show, and this is on a 10-year historical basis, and it's a comparison of various, say, traded credit categories, which I hope you can see my mouse, which is being the S&P 500 to represent equities, U.S. corporate investment grade bond index, U.S. leverage loan index, which is leverage loans being predominantly referring to bank syndicated loans, and U.S. high yield index, and comparing the volatility, which you'll see in these lavender boxes, against the annualized return over that 10-year period, which you'll see in the sort of, hopefully I got the colors right, lavender, I think that's lavender, and this is I guess I'll call it off purple. And so if you look at this, what this actually shows is if you look at, or what you should take from this, is the volatility of the traded asset classes is multiples above the actual annualized return. So a different way of putting that is like, so here for the S&P 500 over the last 10 years, you could say you get a 0.7 or 70% compensation for risk. Whereas if you then look at private credit, what you have in private credit is the return, the annualized return actually exceeds the volatility. And so if you invested in the asset class, you're actually getting a multiple return for the risks you take. And it is actually less than one for the rest of these asset classes. And so really what this demonstrates is the superior returns and the lower volatility that private credit can provide, and why it can be a really nice and attractive kind of value-added allocation to a broadly diversified investment portfolio. And this is precisely the reason why you'll see institutional investors are really attracted to this asset class and have made significant investments and have core allocations into global private credit. Now, on the next slide here, this is just a different way of showing the exact same information. And all this seeks to do is to show that if you were to put have invested $100 into the asset class 10 years ago and compares that against all the other asset classes, and what you'll see is a couple of things. Firstly, this sort of I guess purplish colored bar is the U.S. private credit, and what you'll see is just the really stable growth over the period of time of the return profile, which kind of is a representation of the low volatility. And also you can see that the magnitude of drawdowns over that time are quite different, meaning kind of periods of loss. So if you were to invest and keep a nice core allocation into the asset class, you'll get the benefit of the compounding returns over time that have lower drawdowns and minimal volatility. And so this is just a different way to kind of try to illustrate the point. So I guess with that, I'll close off before taking questions. Just to reiterate the key takeaways. Global private credit, very nice, diverse and defensive asset class with really attractive risk-reward benefits relative to other investment alternatives. And this is something that we feel and believe will be sustained for quite a period of time, given those supply-demand dynamics in the U.S. and Europe, which have only recently been exacerbated by, failures of Silicon Valley Bank and Credit Suisse. So we would expect that to continue for quite some time. Secondly, it's a really nice diversification tool, and you have for a portfolio, and you have a wide range of options that you can actually choose from depending on the kind of risk reward that you want to realize. And then finally, we just say that it would be a very good thing to seriously consider holding global private credit as a core part of your investment portfolio. And so with that, I'll thank you for your attention and hand it back over to Adam.
Thank you, Nehemiah. That was certainly very comprehensive. I guess the most obvious question is, if this opportunity is so good, why doesn't everyone have private credit in their portfolios?
So I guess firstly, this has really been the home of large institutional investors, so like the Future Fund and the industry super funds, because they actually have the scale to be able to build diversified private credit portfolios. And if you were to actually look at how they do it, they will actually be allocated into domestic private credit as well as global private credit. And they will also diversify across strategies. So they actually won't play one strategy. They'll play all four categories of strategies as I've articulated earlier. Now, for non-institutional investors, it's very difficult to access the asset class. Okay, and the reason for that is first of all, if you think about what's the process you actually have to go through, there's a few key things. The first is it's very difficult to access. And the reason why it's difficult to access is because you then have to be in Europe and the US, you have to be able to identify funds. Identifying the best funds is actually what you want to do in this space. There's tons of them around. And what you really want to be able to do is identify across each strategy, who are the really good funds. When you do that, you have to be able to assess and diligence the funds, and then you have to be able to secure access to them. And by the way, to secure access to any one of these funds, broadly speaking, their initial or their minimum investment is anywhere between 5 million to 15 million, right? And for the really popular ones, they're typically closed to new investors. So you actually need to be able to, find a mechanism to get in. Secondly, diversification is really hard to achieve. And when you think about it, you need a lot of money to be able to diversify across strategies if you want to play this asset class like, the institutional investors do on a very diversified basis. The other thing about diversification is, and I'll give you an example, it's very difficult for Australian investors here. Whilst in this country, you can invest in a direct lending fund, but at best you might have 10, maybe 15 individual names, corporate names in Australia that would sit in those portfolios. Your top senior direct US manager would have at least a few hundred that are spread across, a much wider geography and a whole bunch of different segments. And then thirdly, there's long drawdowns, investment periods that are associated with fund managers in this space. So what that means is specifically, if you talk to a fund manager in this space, they'll talk to you about the IRRs that you can realize through an investment in their fund. Where in actual fact, what you're actually doing is they will ask you to commit, let's say, $100 to the fund, or you might commit $100 to one of these funds. But they would typically have a 2 to 4 year, depending on the strategy, a 2 to 4 year capital call on that $100, which means day one, when you commit, you need to really kind of stick that $100 in something that's liquid, because you have to be able to, when the investment manager calls your capital over time, you would then actually have to be able to fund that. So the implication of that clearly is that because your $100 isn't immediately invested, you're not going to realize the IRR that's advertised, because a fund manager only gives you the IRR on the capital that they've called from you and committed into investments. And then finally, the final issue is, fixed income is meant to be a stable income generating asset class. These are US dollar and euro denominated funds. Because they're illiquid as an asset class, are very difficult to hedge or very, very costly to hedge. And so getting stable exposure when you're an $A investor to an asset class where it's very difficult to hedge creates real issues. And that's the reason why you don't see very many retail investors invested. What you see is institutional investors or wealth groups who can aggregate sufficient capital to be able to deploy into the global asset class.
Okay, you just mentioned diversification now, and you touched on geographic diversification. Previously, you spoke a little bit about asset class diversification. Is the geographical component as important within private credit as it is within other asset classes?
Yes. Look, I think the first question, I guess very simplistically to answer that question, I would say, in a way, this is the question I'd be asking, everyone to think about, including the things that I think about, which is, would you put all your money in one stock, or would you diversify your stock holdings? Would you buy Apple, or would you buy Facebook, Apple, Netflix, and Google, right? Would you buy Aussie equities, or would you buy a combination of Aussie and global? So I think just that is something, that if you believe in diversification to kind of maximize return or risk-adjusted returns in a portfolio, I think it's crazy not to, okay? Then when you kind of talk more specifically about private credit, I think accessing Aussie private credit, to me, is basically kind of two things, right? You are concentrating in areas where banks don't have the risk appetite to lend. And so by definition, you're taking a higher risk profile in what you invest in. But that said, we have great managers, right? And you get compensated, you get really nice returns. Okay. But the fact of the matter is you don't have the same kind of opportunity to kind of tune where you actually want to play in the risk profile on a diversified basis. And secondly, what you'll find is, particularly in the corporate loan market in this country, it's very hard, like I said before, to build really widely diversified portfolios. So if you want to get that access to corporate credit on a diversified basis where you get a nice illiquidity premium, you really have to go offshore to get that size. And then I guess finally, if you think then about the Aussie economy and where you're taking your risk, well, in Australia, I think very simplistically, the macro risk that you're taking is, in particular, it's unemployment risk. So will unemployment go to 7 to 8% levels? Because at the end of the day, we're a very high services-oriented economy, and a lot of the ABS is actually focused into consumer or consumer applications like autos, residential, etc., which do have themselves, quite nice, collateral support. But in a 7 to 8% unemployment environment, if things continue to be quite tight, notwithstanding the fact that we have tight unemployment, if anything was to loosen and unemployment was to rise, which is exactly what interest rate policy is focused on, then I think that puts a lot of portfolios at risk of higher losses. It doesn't mean you won't get your return, because credit is a really nice asset class with nice LVRs and nice returns. It just means your returns can be quite diluted. And why wouldn't you be diversified, across the globe in order to kind of minimize kind of single economy risk?
That makes sense. Questions are starting to come in quite thick and fast now, so I'm going to try and group them, and if possible, sort of combine a number of questions. So if you don't hear your exact question, it's possibly the reason why, and the answer should cover it regardless. But you spoke about a range of strategies providing different risk and return options. How should one think about allocating across those options?
Yeah, so I guess the first thing is, to the extent that you can do it, you want to kind of, I think, do what you see large institutions do, which is take global diversification and also take strategic investment strategy diversification. But let's say if you don't have the scale or wherewithal to do that, or if you if you're a high convicted investor and you'd buy Apple instead of Apple and its competitors, then the choices that you have to diversify really come down to what's the risk reward and liquidity profile that you want to achieve. So for example, with direct lending strategies, they tend to have more liquidity. And when I say more liquidity, there's kind of two things there. One is that say 90% of the return that's actually earned in a direct lending fund will be from interest payments on the debt, right? So you might get monthly income, or you might get quarterly income, from those funds. And in those funds, they would, generally speaking, have at worst would have kind of a 3-year liquidity profile. So what I mean by that is your average direct lending fund would have assets that are written or loans that are written on a 5 to 7 year maturity, but the average life of those loans is typically 2.5 to 3 years. So as a result of that, if you're buying into a direct lending manager, you can be pretty comfortable that over a 3-year time period, a third, you'll get your capital back at worst sooner, depending on the liquidity profile of the underlying fund. Now, on the opposite end of the spectrum, when you look at, say, distressed debt funds, they're very, very high returning, okay, because of the nature of how they invest. They're about half income, half capital appreciation from the equity positions that they take. But those funds tend to be very illiquid. And the reason why is, well, one, they would be closed end, and they're closed end because they would have, say, a 7-year closed end fund, for which sort of the first 4 or 5 years would be the investment period. And what those funds would seek to do is to recycle capital over that period, over that investment period, to then realize the return. they're not liquid because if you're earning, very high interest rates on debt that you refinanced within it, you'll keep that capital in, right, and continue to reinvest it and recycle it into new opportunities. Number one. And number two, because a bunch of the super returns or half that return will come from equity, it takes time for those returns to realize. Right. So once you've restructured a company, you kind of take your debt out, you go to the next opportunity, you've got equity that's kind of left waiting to appreciate, and it takes time for that to happen and then to realize it. So those funds you'll be putting away for sort of a 4 to 5 year time period, and you'll get all the capital back sort of towards the end, but you have no real liquidity along the way. So I know it's kind of a long answer to what might appear to be a simple question, but it's also because of the nature in which the fund managers operate their funds and the liquidity they provide and the return that you get, depending on the strategy that you choose to invest in.
Okay, we are running out of time, and I do want to try and get through another few questions. So please, can I ask you to keep your answers a little bit shorter?
Yes, apologies. Yes.
First question, well, next question. The fact that the market has been growing at such a rapid rate, is that cause for concern?
Look, I'm not sure. I don't know why it would be, and I think it's much more positive than a negative, and there's a few different reasons. Number one, if institutional investors had not stepped into this space in the U.S. and Europe when bank capital was withdrawn, I think you would have had some pretty significant economic consequences that could have looked like the GFC did. Okay. Number two, you got to really look at what's actually causing this growth, and it's really caused by a liquidity gap. Okay, most I think bubbles or most things, when you get really concerned about the growth of allocation of assets into a class, is typically not because there's been a massive withdrawal of capacity. It's because someone's like in the tech boom. Someone finds the next big thing, everyone rushes and puts their money into it. This is not a phenomenon that's been created by that. This is a phenomenon that's been created by a massive gap of capital that has a massive amount of capital withdrawn from the market as a result of regulatory impost into a major provider of credit. Okay, and so when you look at SVB and Credit Suisse, and you just look at what alternatives companies have to raise debt capital, that's been removed, and it's going to take time for the institutional investor market to be able to go to invest in the private credit funds that deploy it. And we just talked about the difficulty in the liquidity profile of some of the funds that you'll invest in. So it actually hasn't caught up to kind of a new type of banking sector that provides the liquidity that's available, that has been in past available from banks in deploying that capital. So I don't think it's a bubble. I think it's a long-term structural gap that has to actually get fixed.
Okay. What are your thoughts on the use of leverage amongst private credit funds or managers?
Yeah, so it makes a lot of sense to use leverage in certain circumstances to be able to juice up returns. Okay, so let me tell you what I mean by that. So for senior first lien, so top priority security lenders, you'll find that the top investment managers in that space will have actual net realized loss rates that are lower than 50 basis points, okay, which is indicative of the underwriting. It's indicative of the structuring. Those funds, when you have a loss rate that's lower than 50 basis points over a very long period of time, you're nuts not to leverage that, number one. Number two, the leverage of the best managers would typically be no more than, at best, at worst 2 times, but generally speaking, about 1 times. And that 1 times leverage will generally, broadly speaking, generate sort of 200 to 300 basis point additional return for extremely low loss rates. And if done on a really sensible basis, makes a lot of sense. Now, the other flip side of the coin is you'll find that on your distressed investors, as an example, there is no leverage used. The returns are already really high. There is actually no reason to be deploying leverage into what is already kind of a leveraged situation. So I would recommend absolutely be looking at leverage for senior first lien managers.
Okay, Great, that makes sense. And another interesting question here is, how should we think about the risk-return characteristics of private credit relative to leveraged or syndicated loans, which are sort of more common in our market?
Yeah, so okay. So if you look at the difference, I think the way of looking at it is to actually look at the differences. Okay, so number one, in syndicated loans, so one is kind of a risk thing. When you have bilateral loans, you actually have a much higher ability to, because you've negotiated them, a much greater ability to do two things. One is if things go bad, it's a bilateral negotiation. You kind of control what the outcome can be because of the rights that you've actually negotiated. When you're in broadly syndicated loans, you're in a situation where you have a multi-creditor environment, and irrespective of some of the protections that are in place for that environment, you still need a bunch of creditors to actually agree ultimately to outcomes. And the bigger the syndication, so the more investors that are involved, the harder it is to kind of get everybody, enough people on the same page to actually get those outcomes. So that's one thing on the recovery side, and the other is broadly speaking, is syndicated loans, and also in publicly traded credit more generally. You can get covenant protection. A lot of them are covenant light, but you can get covenant protection. But what ends up happening in those situations is you generally only ever work out there's problems when and can only take action when there's an actual default. And what you have in private credit with the bilateral nature of the loans and the way that a lot of particularly with top managers, the way that they actually structure the agreements is they will have information rights. So they'll get monthly management accounts so they can actually see how is the company going. So they have a very ongoing dialogue. They actually know if there's issues coming. They're already having this discussion with a company about how they're going to rectify the issues. And generally speaking, nobody ever wants to, the borrower nor the lender in those cases, ever wants to get to the point where the private credit provider has to use an actual contractual default to have to go in and change the face of the company. Okay. And you can't do that when you're in syndicated loans.
Thank you. Unfortunately, we have run out of time. There are a lot of questions that I haven't been able to ask. And so if we haven't answered your question, we will get back to you directly. We have received a number of questions around product, and we haven't mentioned anything about a product in this webinar. So Nehemiah, maybe you can tell people why we are having this conversation today.
Yeah, so I guess a number of reasons here. The first is there is all the market chatter. There's a lot of global managers that are coming down to Australia to access our large pool of superannuation savings. And I think at the outset, it was just very important, given what, I'm trying to do here, it's really important to be part of the education process, about what is global private credit, why should you consider it? What should you look out for? What are you comparing it to? Just very simplistically. Number two, we're entering into a real decumulation phase, right? And you start to see this in the press now. So it's going to be increasingly important, I think, for Aussie investors, particularly with your super funds, to be considering how you can get really nice, high-yielding, low volatility income into your portfolios for when we have an aging demographic. And then, finally, I think, it's really important to be diversifying your portfolio. So it's very important to be able to try to give access to investors, meaning non-institutional investors, to this asset class. And so pretty much, a lot of the effort, my personal effort and the effort of Pengana Capital more generally is to actually find ways of overcoming those challenges to be able to provide investors, wholesale investors, with access on a diversified basis to this asset class.
Okay, so I guess the key message there is that while we are not talking product quite yet, We have established a business. We have got really high quality people behind it. So keep your eyes and ears open, because something exciting is definitely on its way, and I have no doubt that you'll be hearing from us shortly. Thank you very much for those who joined us today. Thank you especially to those who asked questions. As I said, if we didn't get to your question, we will respond to you directly. And if you have any other questions, please get in touch with us. We'd love to hear from you. Enjoy your afternoon.